All right, good afternoon, everyone. Welcome to our very first pitch of our combined program from St. Petersburg, Florida. This year, we have the pleasure to have our Tampa and St. Pete students doing a joint pitch for the first time. And I can't wait to see both groups presenting their stocks today. We'll have 3 buy stocks, and you will get a chance to ask your questions during each Q&A. And as a final reminder, please don't forget to vote. You have received a ballot link in the invitation email. Without further ado, let me introduce the first group from our SIMP program. And as a courtesy reminder, SIMP board members, you have the priority in asking questions during the Q&A, so please don't be shy. And all guests, you're welcome to ask questions during the Q&A. If you have any comments, feel free to type it in the chat box if we cannot get to you in time. All right, thank you. Let's get started. Group 1, Ford stock.
Hi, my name is Miranda Brozek.
I'm Charles Diamond.
I'm Matthew Englander.
And I'm Donovan Murphy.
And we're pitching Ford today as a buy. Ford Motor Company was founded in 1903 and is one of the largest vehicle manufacturers in the world today. Just last year, it beat all of its competitors in unit sales. Ford dominates the light truck market, and the Ford F-Series has been the best-selling car series every year since 1977. Ford has also made significant investments in the EV industry within the last 5 years. Just this year, coming out with the Ford Mustang Mach-E, its first fully electric vehicle. It is expected that EV sales will constitute 40% of Ford's total sales by 2030. Ford has a strong brand image and brand equity. Ford has a diversified portfolio with both proven and innovative offerings. The average Ford F-150 buyer is 55, 14% of its buyers are women, 86% are male. Primarily, customers are white males, but other segments have been growing. Between 2010 and 2017, 42% of the Ford F-150 buyers were Hispanic buyers. Ford has adjusted strategy from cost leadership to market penetration, product development, and market development. Today's price, as of November 16th, around 10 a.m., was $19.60. The target 12-month price is $24.54. Ford has recently reinstated its dividend at 10 cents per share, and the payment of that began in November. Even with the microchip shortage hurting all of the auto industry, Ford has beat analyst expectations of for quarter 3 by double. Jim Farley succeeded the former CEO, Jim Hackett, in October of 2020. Farley has planned restructuring of the company continuing until 2030, focusing on accessibility and mobility, electric vehicles, and on commercial customers. Shares have increased 270% since Farley has transitioned from COO to CEO. And I'll hand it to Charles for examples.
So Ford relies on their strong brand recognition to drive sales. They currently hold 43% of the commercial full-size truck and van market. They have the Ford F-Series, which is the best-selling car series over the last 45 years, the Ford Mustang, which is the best-selling sports car, the best-selling cargo van in the Ford Transit, and the best-selling SUV in the Ford Explorer. The Ford Ranger is also the second best-selling truck outside of the United States. So Ford's Plus restructuring plan includes a 3-phase electrification approach. They're currently in phase 1, which is early adoption. They started this year releasing their first fully electric vehicle, the Mustang Mach-E, and they just released last month the Ford Maverick, which is a hybrid truck. The Mustang Mach-E spends roughly less than a week on average in lots before selling. The Ford Maverick has already received enough reservations to production. Their second phase is their transition phase. Well, they'll start producing EV models of their highly produced vehicles. They release next month is the E-Transit, which is the electric version of their cargo van, and they release in the spring of 2022 the Ford F-150, which is the EV model of their F-Series. Both of these will be produced in their Michigan plants with battery cells coming out of Korea until at the end of 2022, the Ford Iron Park will be completed, which will produce their solid state and lithium-ion batteries. Phase 3 is a high-volume EV assembly, which will lead the next fleet of Ford vehicles starting in 2025 in high enough volumes to go with the amount spent on investments in software and production. So EV investments. Last month, they announced an $11.4 billion investment plan with SK Innovation Energy Company to build a large EV campus in Western Tennessee and twin battery plants in Kentucky. Their large campus will house the production of the F-Series and advanced batteries, while the twin battery plants will power the next lines of Ford and Lincoln vehicles. As part of their overall plan to invest $30 billion in EV and sustainable energy, they invested $50 million into Redwood Materials, which is a battery recycling company, in hopes of closing their supply chain loop. Redwood Materials technology has ability to recover 95% of important elements such as copper, nickel, and lithium from batteries out of circuit. Ford also holds a 12% stake in Rivian on a $1.2 billion investment in 2019. After Rivian's IPO last week, that investment now has a market value of over $16 billion. So Ford's revenue stream. Ford's revenue comes from 4 different segments: sale of automobiles, Ford Credit, leasing, and vehicle maintenance. Overall, semiconductor shortage has hurt automobile sales across the board, but Ford has been able to cut cost, doubling its profit margin. As guidance suggests, production will increase in the fourth quarter as supply chain issues. Ford also outsold all of its competitors in U.S. automobile sales with over 150,000 units in the third quarter. I'm going to hand it off to Matt now to go over the evaluation. Yeah, absolutely.
So here we have a DCF model that we created. We have the assumptions up in the upper left-hand corner with the tax rate at 14.65%, with a calculated WACC of 7.83%, which is slightly above the industry average of 7.8%. And then with a perpetual growth rate of 3.2 and an EV/EBITDA multiple of 22.3. The intrinsic value of Ford we believe to be at $23.66, which is about a 21.2% upside of its current stock price. Moving on to the growth and profitability. Here are some metrics regarding those. We have the revenue growth of 2.8% last fiscal year, and then operating earnings per share TTM CAGR over the charted period is 1.3%. We have the net profit margin of 5.6%, which is 2.2% above the period's mean net margin return, which, as for their restructuring plan, where they want to cut costs and increase profitability, we can see that Ford is going into that direction. And currently operating at a net profit, or the return on equity of 19.1% is 3.8% above the period's mean, which we believe is favorable. And so we're going to talk about rising interest rates and capital allocation. With $31 billion cash on hand, Ford plans to repurchase their high yield bonds that they issued during 2020 during the pandemic. And so as they repurchase those bonds, they plan to issue new ones at 3.5% to 4.5%. With this restructuring, this will help fund the restructuring plan. And with debt maturities across 2021 and 2022 being at $4 billion, we're confident that Ford's going to be able to hand these debt obligations. And with the automotive industry highly discretionary, so rise in interest rates or rates correlate inversely with sales. We see vehicle sales dropping as interest rates rise, but we see that Ford Credit's going to benefit from this with higher interest rates. And moving on, I'm going to pass it off to my colleague Donovan to go over the competitors.
Hello, my name is Donovan, and first I'll start off with Ford's competitors. Ford's main competitors include Tesla, General Motors, Toyota, and Chrysler. I'll talk a little bit more about Tesla and General Motors when I get to risks. These companies operate with high barriers to entry in an oligopolistic market structure. Ford is planning to differentiate their market offerings from their competitors by allocating capital to truck, hybrid, and electric vehicle offerings. And the graph on the right is the current stock price changes over time. You can see that Tesla is currently leading, but Ford isn't too far behind. Now I'll talk about the risks that Ford faces. Overall, the biggest risk that Ford faces is the global redesign of the company. And the redesign is a focus moving away from their sedan production models to their higher profit margins, such as their trucks and their vans. They're decommissioning plants to make way for these higher profit margin offerings. They've decommissioned plants in India, Argentina, and Brazil, and they will be opening up new plants in the Blue City Park and Louisville, Tennessee, and Kentucky. As far as competition goes, I think our biggest competitors will be General Motors, which is also undertaking the electric vehicle offerings, and Tesla. So Ford has a few advantages over General Motors, and those are that in the last quarter, General Motors was able to produce 111,000 vehicles, while Ford was selling 156,000. Ford managed to scoop up an investment in Rivian, which is now worth $16 billion, but it only cost them $1.2 billion at the time. And instead of that, GM invested in Nikolai, which did not do well. The third thing that they have over General Motors is that General Motors investments in electric vehicles will only produce 750,000 batteries annually, whereas Ford's will produce 1 million batteries. As far as Tesla goes, Ford will have less expensive batteries. They will have more flexible production lines. Tesla's automation focuses on high volume, while Ford's CNC automation is more geared towards smaller and mid-sized fleets, and they can use that CNC to create a variety of different products, whereas Tesla is more focused on their current models. We spoke about debt and rising interest rates earlier, but I would like to add that the Fed has been tentative in the past to raise interest rates based on how it would affect the automotive industry. And the material shortages we'll talk about in the next slide. And increasing oil prices might have a negative impact on motor vehicle sales, specifically combustion vehicle sales. But right now, futures prices look stable. The next thing I wanted to talk about was mitigating supply chain risk. This is mostly based on the semiconductor. And as stated earlier, Ford is performing better than its competitors in acquiring semiconductors. They had the highest unit vehicle sales in the United States last quarter. Ford plans to engage directly with semiconductor fabricators and other key electronic component manufacturers. They'll be providing long-term forecasts to its critical suppliers. And Ford has issued positive fourth quarter guidance for semiconductor acquisition. And as far as batteries go, they'll be investing in Redwood, and they will be able to convert their recycled batteries back into new batteries at a much lower cost than they otherwise would. For investment catalysts, we can see that Ford's ongoing restructuring is finally seeing results thanks to our new CEO. Ford expects to invest $30 billion on EV offerings by 2025, and it's expected that that number will continue to raise as we get closer to the deadline. The dividend has been reinstated following a strong Q3 earnings report, along with intentions to pay down debt with future earnings. Revenue expected to rebound as supply chain issues ease. And in summary, Ford has considerable brand recognition with 43% of truck and van sales. Ford has chosen to restructure and allocate its capital to higher performing market offerings. Future earnings growth will be dependent on the growth of the electric vehicle market, the success of the global redesign, actions of competitors, and resolution of current supply chain issues. Thank you very much, and we're pitching forward.
Are we ready for questions?
Yes,
Yes,
please.
yes, sir.
Yes, sir.
I'm trying to phrase some of this as a question, so let me just make a few comments, and you can respond to my comments as if they were questions. You mentioned that higher interest rates might decelerate car sales, but on the other hand, it would make more money for Ford's credit operation. However, the money you make in credit is not based on the absolute interest rate. It's based on the spread between what it costs you for the money versus what you can sell the money for. Did you look at the spread before you assumed that there would be an offsetting benefit to them?
Unfortunately, no. We assumed that revenue would fall regardless because of less vehicle sales and less loans given out, but we did not take that into consideration.
If anything, we think the impact on credit will be slightly less then, but it would still not be positive for Ford Credit.
You think it would not be positive for Ford? Because you said it would be in your presentation. You said the credit would be
So
positive.
it would make credit more profitable, but not increase the revenue, and that was my mistake.
So I'm still not sure what you're saying about credit, but okay, let's move on to other things. When you talked about competition, you talked about how many cars GM produced versus how many cars Ford sold. Now, that doesn't qualify as apples to apples unless I misheard you. So do you want to restate that?
It was unit sales.
Yeah, so Ford led all of its competitors in U.S. automobile sales with 156,000 in the last quarter, where GM only had 110,000 over that same time span. And
Yeah, but when you said it before, you said GM only produced 110,000. Now you sold 110? Which is production or sales?
Sales.
Okay, so that was just, you just misspoke on that. Okay, and then a couple of minor comments that you can take them or ignore them. One is in your report where you talk about the executives, it looks like you just copied that off of Ford's literature, because you're praising these guys rather than doing a kind of an arm's length view of whether they do a good job or not. And the other minor comment is when you talk about percentage changes, like when you go from 16 to 19, you said that's a 3% change. That's actually a 3 percentage point change. Now, I'm sure we all knew what you meant, but just to give you an extreme example, let's say something went from 5 to 10. Well, that's a 5 percentage point, but it's 100% change. And so you have to be very careful when you talk about deltas with percentages to make it clear whether you meant percentage points or percent change. But those are all my questions. Good job.
Thank you for
Thank
the
you.
feedback.
Thank you.
Did anyone have any other questions for us today?
Yeah, we have hands raised, but can you hear me?
Oh, I apologize.
Yeah, we can't see all the participants, unfortunately, so we don't know whose hands are up. So feel free to start speaking whenever.
Okay, I have friends of mine that own Ford. I'm from Michigan. Every one of them has it. The stock was a good buy at 8 or 9. The main reason the stock has gone up so much is because of that truck company. That truck company is the most overvalued stock in the history of mankind. It doesn't make any profit. It sold 150 trucks. It's way more expensive than Tesla. So one of the questions is what are they going to do with that? Secondly, as far as higher gas prices influencing car sales, at the moment you can't buy a car. I'm in the market for a car. Believe me, you can't buy one. They're just dealers in Sarasota anyways have no inventory whatsoever. So I think car sales will continue to be quite robust for the next 6 months or a year because there's a gigantic backlog of purchasers, such as myself and millions of other people who are not able to buy a car. I went over to the Subaru dealer the other day as an example, and he has 100 cars a month. 85 are already sold. Ford's the same thing. They're all sold. Everything is gone. You go over to look at cars, there's 2 cars on the lot where they normally would have 200. So I think that is something you want to look into a little more. I don't think the price of gas and or interest rates are going to have any influence on car sales at all. The only thing is supply. There's no supply. Okay. There's a huge backlog of buyers out there. So that I think is a positive thing. My question is, and I don't have the answer, what are they going to do with that overpriced stock they have that's worth $16 billion? If I was Ford management, I would sell it and invest the money in the company because that stock is so overpriced. But I just wonder if you had any comments on that. Thank you.
So Ford actually gave up their seat on the Rivian board last month. It's still unclear what their exact plan is, but yes, they will have it. They would have enough money they can pay off more of their debts that when they issued bonds last year during the COVID outbreak.
So that valuation is based on a partnership with Amazon. They have dedicated a large size fleet to Amazon once they have their trucks up and running.
For Rivian.
For Rivian.
To make clear, yes.
As far, sorry. As far as what was the, supply shortages, that is the bottleneck for the industry at the moment. Microchips, and so far Ford is selling more cars, and everything that goes to the lot, they have cars sitting in waiting for microchips, and the moment it's moved to dealerships, they are sold immediately.
And they're expecting the supply shortages to start easing up at the end of 2022 or 2023. And according to futures as of today, we're expecting oil prices to remain constant, and they're still pretty high today. So in response to the gas prices, that's what we were referring to, is when the supply shortages do begin to ease up.
So, but really it is the microchips that are halting supply or halting sales at the moment. And that's all the way across the industry.
Yeah, global auto sales fell, I believe, 13.8% as of last year during the pandemic. And so as they will rebound from that, but with the complications of the chip shortage, we're still going to see the supply and demand issues that we're seeing.
But Ford's guidance at this moment is that the chip shortage will begin to ease at the end of the fourth quarter.
Anthony Welch.
Oh, that was us.
That was us. We already talked. This is Art Schwartz, but under Anthony Welch.
Yeah, we're all done. Thank you very much. Good job.
Great job. Thank you very much.
Great. Thank you, everybody.
Thank you.
Thank you.
I've got a question if we can still
Yes.
do the Q&A part. I'm sorry.
Yeah.
Hey, hi, this is Sam Darkatch from Raymond James, and thank you again for all the work that very obviously went into your presentation. I've got a couple of questions as it relates to capacity and Capex in particular. In your presentation, if I'm understanding your DCF properly, you have Capex basically going down after 2021, and then just basically staying in that $4 to $5 billion range. If I look at, and you may not have had access to this, but if I look at consensus expectations for Capex, it really ramps. It goes to $6 billion in 21, $7 billion in 22, $8 billion in 23. And that kind of makes sense because you're talking about double-digit production growth over the next few years. My first question, how sensitive is your valuation to changes in Capex? So for example, if you were to make meaningful changes to your Capex expectations in the $1, $2, $3 billion per year area over the next few years, how sensitive is your DCF to that? And then I've got a follow-up question to that.
Yeah, so it will be sensitive to the Capex, and I don't have the model rate in front of me, but I believe we did a percentage of Capex compared to EBIT based off a revenue forecast model that my colleague produced, and so that's where the assumption came from.
Yeah, I would recommend going forward to use Capex at a minimum as a percent of sales, not EBIT.
Okay.
And I think you're going to find a very different DCF value. I mean, if you were to change your Capex by $1 billion or $2 billion per year, that's taking a good 10, 15% or more out of your cash flows per year. And if you use a single digit whack, all of a sudden you're going to see your value get nailed pretty good. The second question, and this is related, if the industry Capex is really going to accelerate over the next few years, just as a matter of switching production away from combustion engines to EV, what do you think that does to ultimately to pricing and margins, both to Ford and for everyone? And have you contemplated lower margins in your out years in your model?
So could you repeat the last part real quick?
Sure. So whenever, supply and demand, whenever you add supply, i.e. Capex, to an industry, it's going to potentially pressure pricing and margins, right? All else equal.
Right.
On a per vehicle basis, then, what do you have pricing and margins doing over the next 3, 5, 10 years or so that goes into your DCF as well?
So based on their restructuring plan to cut costs and to shut down manufacturing facilities in Brazil, India, and Argentina, with the addition of reissuing the bonds and restructuring their debt, we see that higher profit margins are to come. But based off the model, I don't think it takes into account that long of a higher growth profit margin, as you kind of mentioned.
Yeah, just something to consider, just to make sure that you're being real conservative. Anytime you have meaningful upside into a stock call, you want to make sure that you're being uber conservative and make sure your gross margins are reflective of an industry that is clearly going to be expanding capital going forward. But again, thank you again for all the work you put into the presentation. It was terrific.
Thank you for the question. That was phenomenal.
And then Ray Ferrara, please. Ferrara.
Hi, thank you all very much. Great presentation. Sometimes all the good analysis and the upside that you projected don't happen. What's your exit strategy if it doesn't happen?
That's a great question. So the exit, we didn't propose an exit strategy, but based off the current conditions, if we didn't reach the 2366 price point, or at least the 1 year price target, we would probably sell out. What would you guys say? 19?
I think it's
or 17.8. Yeah, we didn't propose an exit strategy if the price target wasn't met.
Can we get back to you with a better answer for that question later on?
I'm sorry, I didn't hear you.
Maybe get back to you with a better answer to that question later on in the day.
Yeah, I would just propose that you always have an exit strategy for the other way, just in case, because it's what we don't know that we don't know.
Great, thank you.
Thank you. Great question. Thank you.
Do we have any other questions today for Ford? Awesome. Thank you.
Thank you, guys.
Thank you for listening, and thank you for asking us questions. Have a phenomenal day.
All right, thank you, everyone. We'll get a second group ready. Second group will be Amcor. Please, the floor is yours.
Hello everyone, ladies and gentlemen of the board. Thank you for joining us today. I'm Omar, along with Zoran, Umang, and Julian will be presenting what we think is another great addition to our portfolio, Amcor Technology. So giving you some key information about Amcor Technology, they operate in the semiconductor sector, specifically the OSAT industry, which is the outsourced semiconductor assembly and packaging industry. Their current market cap lies around $5.57 billion. Talking a little bit more about their stock, their closing price as of yesterday was $23.30, trading at a beta of 1.58, as well as a PE ratio of 10.27 TTM. Through our calculations using multiple methods, we reach a target price of $29.60, implying roughly a 27% implied rate of return on our investment. Getting deeper into the company, as we said, Amcor is a leader in the OSAT industry. They offer both packaging and testing services to semiconductor manufacturers and other technological firms. They were founded in 1968 and they operate out of Tempe, Arizona. They mainly work on two products, their mainstream and their advanced products. In addition, they report their earnings through these four segments: consumer, computing, communication, and automotive and industrial. Moving on, as we said, they operate in the OSAT industry. They package and test. Talking more about their packaging side is where they case a semiconductor for protection and performance and heat regulation purposes. In their test services, they take the semiconductor and apply specific electrical signals to see if the statistics match the required performance. Getting deeper into the two products they work on is the advanced and the mainstream products. In the advanced products, they use a flip chip to put the die directly on the printed circuit. Some examples of that would be the flip chip scale packages and the wafer level packages. Getting into the mainstream products is where they use the wire bond interconnect technology, where they put the die into a wire bond, a flat frame into the circuit directly. Some examples of that would be the advanced SiP models, as well as the microelectrical mechanical system packages. As you can see on the chart on the left, before 2019, mainstream products were more popular for Amcor. However, in 2019, firms started realizing that they need more efficient ways to implement the semiconductors. That is why we see a slight increase in advanced products in 2019. In 2020, there was a great demand for semiconductors considering the industry shortages, and there was specific shortages in the wire bond products. That is why Amcor was ready there to substitute that with their advanced products. Moving on to their revenue breakdown by this segment. As we said earlier, they operate and they report their revenues using four segments. Their largest segment and most contributor to their revenue is the communication segment, contemplating roughly 41% of their revenue in fiscal year 2020. Main chips in this segment are used into tablets, handheld phones, and smartphones. Moving on to their next segment, which is the consumer segment, accounting for roughly 24% of their fiscal year 2020 revenue. Chips here are mainly used for televisions, visual imaging, and other wearables. Moving on to their third segment, which is the automotive and industrial. I think this speaks for itself. These chips here are used for sensors and driver's assist. This generated 20% of Amcor's revenue in 2020. Moving on to their last segment, which is the computing segment, that generated 15% of the revenue last year. Chips here mainly are used for data storages, as well as data centers. Getting deeper into their revenue breakdown by location, considering Amcor operates on an international level, I'll leave you with Umar.
Thank you, Omar. I'll be discussing the revenue breakdown by specific locations. And so looking at the top left, by revenue distribution by region, the US is in the lead with 47%, and Japan has 23%. Those two are followed by Europe, Middle East, and Africa, as well as Asia Pacific, excluding Japan. As you can see in the graph in the lower left, net sales by region, the Asia Pacific market, excluding Japan, has seen a drastic increase from 2019 to 2020. And this is mainly driven by a growth in demand in the Taiwan market. Moving on to the broad geographic footprint of operating facilities, the total operating facilities span 10.8 million square feet. And of the 10.8 million, 9.8 million are owned and the rest are leased. And as you can see in the map, it is very diverse geographically speaking. Now you may ask us why buy Amcor? Our investment rationale is that it has a strong technological innovation, dominant market share in a high growth industry, and healthy financials and strategic use of capital. Moving on to innovation technologies, I want to focus on communication and the automotive segments. In the communication segment, they have high expertise in system and package. And so this was driven through growth in 5G, and Amcor has really been able to solidify their dominance in this space with their advancement in the double-sided molded ball grid array. In summary, this is very cost efficient, and it has really become more relied on in the 5G market. As you can see on the bottom left graph, in the displaying the 4G and 3G market versus 5G, the purple is 4G while the blue is 5G. In 2019 and 2020, there is significant change from 4G to 5G, and the projections show continued growth in the 5G market, with the 5G RF being estimated to make $2.3 billion in total market size by 2026. Moving on to automotive, the typical past industry method has been wire bond, but as Omar said, it's switching to advanced packaging due to greater efficiency in this method. And also because of the smaller footprint, even though it has a smaller footprint, it is higher density in terms of its packaging, so it is much more effective. And typically in the automotive segment, the advanced packaging is used for ADAS, EV, and autonomous driving. Moving on to industry growth, I'll hand it on to Julian.
Now, in terms of industry growth, the compound annual growth rate for the semiconductor industry is 8.6% until 2028. More specifically, the OSAT industry, which is the industry that Amcor operates, is expected to grow at a 9.1% compound annual growth rate until 2028. And then we have the 5G packaging market, which is expected to grow at an annual growth rate of 31% until 2026. So what drives this growth? First, we have that more IDMs and fabless companies are outsourcing their packaging and testing services to other companies like Amcor. Then we have there is an increased consumption of consumer electronics driving this growth. There's also an increased usage of small packages in the automotive industry because of the electric vehicles. And there's also a miniaturization trend because of system in packaging and a rising demand for 5G, along as Chips for America and FABSAC, which was signed last year, which encourages production of semiconductors in the US industry. Now moving on to market share and customer base. Amcor has the second largest market share in the OSAT industry, but they are the industry leaders in the OSAT automotive industry. In terms of OSAT total market share, they are behind ISE, they have 36%, and Amcor has 20%. In terms of customer base, they have a very diverse customer base with over 275 customers, and their largest customer is Apple. In 2020 revenue, Apple was accounted for 15%. Now moving on to its competitors. In terms of valuation, Amcor it seems to be undervalued in terms of EV revenue, EV EBITDA, and EV EBIT. They have the lowest ratio among its competitors, which implies that they are undervalued. And in terms of PE, they also have the lowest. In terms of debt, they also have the lowest debt EBITDA ratio, which means they are able to easily pay off their debt. Moving on to their financials, when I hand it on to Soran.
Thank you, Julian. So diving into Amcor's financials, Amcor has maintained a healthy balance sheet, which has enabled them to start paying dividends this year and also make strong capital investments to expand their production capabilities as well as their customer base. So their strong balance sheet is demonstrated through two key ratios, the debt to EBITDA ratio and the current ratio. So with the chart on the left, it shows the debt to EBITDA ratios for the last 5 years. In this time period, Amcor has been able to maintain very low levels with a fiscal year 2020 ratio of only 1.17. This demonstrates that Amcor is generating a lot of cash flow and that it is managing its debt very efficiently. And then moving on to the current ratio with the chart on the right, it shows the current ratio for the last 5 years. For fiscal year 2020, Amcor saw a fairly high current ratio of 1.62, which demonstrates the company's robust liquidity and low short-term debt levels. And now moving on to its capital investments. So because of its strong balance sheet and strong financial positioning, Amcor has been able to make key acquisitions as well as construct new facilities. Amcor recently announced plans to construct a facility or a factory in Vietnam so that they can expand their production capabilities globally, as well as add factory capacity. The factory is also expected to help mitigate supply chain issues, as it will add production capacity and also due to a strategic positioning surrounding the emerging markets in the Asia-Pacific region. The factory is also going to be constructed in phases to maintain capital structure integrity, and it is estimated that manufacturing will begin in 2023. The first investment into the first phase of construction is estimated to be between $200 and $250 billion and will be financed using cash on hand. Amcor also acquired J Devices in 2016, which is the largest OSAT provider in Japan. This acquisition helped them to expand their customer base and also contributed to their leading market share in the automotive, in the OSAT industry for the automotive segment. Another key acquisition is the acquisition of Nanium in 2017. Nanium is a WFLO, or wafer fan level out packaging solutions provider. It's a form of advanced packaging solutions that has grown rapidly within the last few years, and we believe that it has contributed to Amcor's growth and leading position within the communications segment. And then looking at the chart on the left with capital expenditures, we projected their Capex values for the next 5 years, and we see steady growth through 2024, where they reached a Capex of $1.5 billion. This is accounting for the construction of the new factory in Vietnam, as well as any other potential acquisitions and factories, like new factories. And then moving on to their risks, these are the three main risks that Amcor faces: reliance on flagship handheld products, highly cyclical industry and impact of supply chain, and delays and issues in manufacturing capacity. So going over the first risk, Amcor is heavily reliant on its communication segment, which accounted for 41% of its fiscal year 2020 revenues. This segment is highly cyclical as it relies heavily on consumer spending behavior, and revenues tied to flagship handheld products also tend to be very seasonal, which explains why Amcor tends to perform better in Q3 compared to other quarters. Moving on to the second risk, Amcor operates in a highly cyclical industry, the semiconductor industry, which is highly impacted by supply chain issues. The industry is sensitive to supply and demand, as well as material shortages and rising material costs. An example of this is the wire bond shortage, which has put a strain on Amcor's mainstream products. And then lastly, Amcor faces potential delays and issues in manufacturing capacity. Last year during the pandemic, Amcor, along with the entire semiconductor industry in general, had to reallocate their manufacturing capacity from automotive to other segments that were performing better, such as communications and computing, due to auto demand plummeting. Even in 2021, despite auto demand recovering pretty well, it has been difficult to reallocate this manufacturing capacity back to automotive due to the supply chain issues and material shortages. And lastly, I'll be going over our valuation and how we calculated our target price. So we allocated 70% to our intrinsic value that we got from the DCF model, and then 10% each to our EV EBITDA, EV revenue, and PE sensitivity calculations. And with this allocation, we reached a target price of $29.60. And then we considered potential upside and downside and calculated price targets for our bull case and our bear case. So for our bear case, we reached a target price of $26.87. This is assuming that that the promising trends in 5G and the other promising technologies don't meet growth expectations, and that Amcor is not able to remain innovative and preserve its market share. But on the upside, we reached a target price of $33.16. This is assuming that these trends surpass expectations and that Amcor is able to gain market share within the OSAT industry. So to conclude, we believe that Amcor is a buy due to the strong growth and promising technologies, as well as its leading market share and innovation within the OSAT industry, and its healthy financials and strong capital investments. And now we'll be moving on to our Q&A segment.
Good afternoon, gentlemen. Thank you for the time. I think you did a great job with the presentation.
Thank you. Thank you.
Comment for you and then a question. This is Daniel Mannix. So comment number one, there are a couple charts that you showed there. I believe it was debt to EBITDA and current ratio. If you're showing how impressive results are, it's usually helpful to compare it against the peers. If you want to show improvement in results, that's when you would show it over time. So if that was getting better, I would show the history of that. It's a lot more helpful to see it versus peers if you're talking about whether it's better or worse. The question that I have is on the supply chain. So obviously the COVID-induced supply chain bottlenecks over the last year or two are constantly being talked about. Curious if you know anything, if you've talked to management about both sides of the supply chain. So thinking about the largest material cost for chips being silicone, the price of silicone has gone through the roof over the last year and a half. Any word on what management is thinking about that, what expectations are for costs going forward, how they're hedging against those costs or mitigating those costs, whether there's other materials that they could use instead of silicone, I'm not even sure about, but I'd be curious about that. And then on the other end of that, for their clients, we've heard more and more about having more control over your supply chain and potentially some deglobalization, bringing supply chains, locally, domestically. So you talked about the Vietnam production facility. Talked about have they talked to any of their customers about that? Any word on whether it makes sense to do more here in the U.S.? How much of a concern that is longer term, or if that's considered to just be a short-term disruption?
All right. So talking firstly about the supply chain issues, as we mentioned, they're pretty diversified in their income as well as their geographic locations. Considering their largest customer, which is Apple, accounting for 14.7% of the revenue last year, Apple has its manufacturing centers in China, so having locations closer to the Asia Pacific makes more sense, I think, for Amcor. When it comes to the supply chain issues affecting material prices, all I've read is that they started buying forward contracts on materials to try to sustain their cost levels over the years. They have shown great margins over the last years. We went conservative with our margins, considering they're not decreasing them over the years. But yeah, other than the forward contracts, they don't seem to have any substitute for silicon currently.
Yeah, and also just to touch on something else. So as we mentioned, Amcor, specifically within the automotive industry, is transitioning from wire bond to advanced packaging solutions. And this is mainly one of the reasons is because of the shortages in wire bonds throughout the last year. So Amcor is prepared in that case to transition to a new type of technology and overcome that supply chain issue.
Got it. That's great. Thank you.
Thank you.
You guys have done a lot of work, so I hate to be sounding so mean as to pick on you here, but I'm going to pick on you anyway. First, a very minor thing. You have a pie chart that's not round. It's very hard to look at. I don't know what happened when you were creating the document that made that happen, but more to the point, your thesis is built strongly around the idea they have a strong balance sheet. And on the page where you talk about some of these issues, you use the word healthy 3 times and the word health 1 time. And those are not financial terms. So it comes across more like arm waving than real analysis when you use the word healthy so much. So what I would ask you to do, and maybe you can't do it standing here right now, but I would ask you to justify the claim of a strong balance sheet without using the word healthy, without looking at the current ratio, and without EBITDA. Can you do it without those 3 things?
I can make an attempt. So with their balance sheet, they have maintained pretty strong cash levels due to strong cash flow generation throughout the years, and they have also been repaying their debt. I believe in 2016 their debt was around 1.5 or 6 billion, and now it's around 1.1 if I'm not mistaken. And they also have a plan to repay their debt until 2025 and completely pay it off. We haven't, of course, found any information on whether they're going to issue more debt, but assuming they don't, this shows that their debt level is steadily decreasing throughout the next 5 years. And so comparing their cash to their decreasing debt, it seems that they have a pretty strong balance sheet.
How about comparing their cash to their requirements? If things go wrong, things go right. They have enough cash to get through a tough time if one comes up?
Yes, I believe so. I believe they have enough cash because they use a lot of cash for their capital expenditures, and they also just started paying dividends. So it shows that they're in a pretty they have a pretty strong cash position. So if they do face any challenges, they could allocate more of their cash towards those challenges rather than these other areas.
Adding to that, the firm has enough cash from last year where they made short-term investments, I think worth $500 million. So I believe if they need any more cash, they can liquidate these short-term investments.
Now, would they be able to continue to maintain their dividend? Because it's terrible if you stop your dividend. So is there cash to get through hard times and maintain the dividend?
Their dividend is not too high. They just started paying this year. And their cash level is not like an issue in terms of paying dividends. And it's also, before their cash they are able to continue the capital expenditure, and they even have a cash, excess cash. We don't forecast that they are going to do anything else like buying back shares, because they didn't mention anything about buying back shares, or so we just expect them to continue paying dividends and increase their capital expenditures, and even after that they still have some excess cash.
Okay, good answers to questions you didn't expect.
Thank you.
Thank you.
This is Sam. Can you hear me okay?
Yes.
Yes. Hey, and again, terrific presentation. Thank you for all your efforts. One observation and one question. Your bear case is $26. Stocks, I think, at what, 23? You're basically saying you can't lose, which obviously is not the case. At a minimum, I think I would just look at, hey, for years and years and years, this stock has traded at 50% of sales. Probably, a reasonable base case or bear case would be just the market just returns it back to half of sales and call it a day. You're already going to get folks looking at you a little bit of a jaundiced eye if your bear case is 15-20% upside from current levels. My question is this: there might be a fourth risk, which is the Kim family, which owns 40-50% of the shares outstanding, and they've been selling. And I believe it's in a trust or some sort of a trustee format. Is there a plan for them, or has there been a stated plan for that ownership, and how much of that equity do you expect to keep coming out over the next few months and years, and does that create headwind or something to be concerned about?
So I would say with the sell-off, that there has been a recent sell-off, and this actually caused the price to decrease from, I believe, a high of 29 to the current level where it's at around 23. I believe the sell-off happened about a month or two ago. But we haven't found any information on the reasons for the sell-off or any plans for it in the future. But based off the information that we have, we don't believe that there's any fundamental issue at stake or any fundamental reason why they're selling. We can only really speculate.
Understood. And it's not a deal breaker in and of itself. It's just something to be aware of, that there's an awful lot of stock ownership in one set of hands, and they've been doing something that's the opposite of what you're recommending. That's all. Thank you again.
Thank you.
You're welcome. All right, does anyone have any more questions?
There's a hand right there.
Sam Darkat. Oh,
yeah.
The Lord is on.
That was me. Okay, sorry.
All right, appreciate it. All right, so if we're out of questions, thank you so much for listening. We'll leave you with the other group. Appreciate it.
Thank you so much.
Thank you. Thank you.
Thank you, Team 2. Now we have our third pitch, Marine Max, which is actually located in our neighbor city, Clearwater, Florida. Some of you may enjoy a nice day on the boat in Florida, and let's hear why we want to buy this stock. Please.
Hello, I am Sam. I'm here with Carlos, Tyler, and Hitali, and we have something for you today called Marine Max. Now, here in Florida, we have people moving in every single day, and everybody wants to take advantage of all that the Sunshine State has to offer. And what better way to do that than to buy a boat? That's what a lot of people have been saying over the last couple of years throughout the pandemic, and are continuing to say. Now, for Marine Max, we have a current share price of 56, 2-year target price of 78, implied return of more than 38%. Now, the largest recreational boat dealer in the world, which is increasingly becoming a one-stop shop for all boating needs, is now undervalued with a PE ratio of 8. Seeing this, it would certainly be a stock that you would want to buy. But we're going to go into a lot more detail, especially when that company has 25 premium brands and 100 locations, and is increasingly relying more on higher margin, less cyclical businesses in its revenue. Now, with the revenue breakdown, 80% of the company's revenue comes from new and used boat sales. Of course, boys like boats, girls like boats, everybody likes to buy boats. But once you buy the boat, you have to take care of it. And that's where a lot of these other businesses come in, like maintenance, repair, storage, parts. And we have seen them go from 14% of total revenue to more than 18.6% since 2016. And that is very good news for the company, especially because new and used boat sales have been really trending up, especially in the last 2 years. So even though that's been happening, they're seeing these other businesses trend up even more. And it's part of their corporate strategy to keep on expanding. And Hitali is going to talk a little bit about that.
Hello, everyone. My name is Hitali, and I'll be sharing the corporate strategy of Marine Max. So we have identified 3 major strategies of Marine Max. First is sales of new and used boats. They have exclusive dealer agreements with Brunswick and Azima boats, which provide them sustainable inventory at a reasonable price. And it also makes them the exclusive sellers of those boats in a particular geographic location. So if a customer really loves Brunswick boats, then they have to go to Marine Max to purchase that boat. The second strategy is focused on higher margin business. So higher margin business includes marina, storage, the maintenance, and the repair facilities. So with the acquisition of Fraser Yachts, Skipper Buds, and Northrop Johnson, Marine Max has become the world's largest yacht service organization. The superior yacht service business has higher margin. It has margins from 30 to 70%. So right now, the revenue mix of Marine Max has 18% of its higher margin business. But in the future, they are planning to expand those margins. The third strategy is operational efficiency. So Marine Max has decentralized approach to the operational dealerships. So whenever Marine Max
purchases any company, it does not take over the entire management. It allows the existing owners to operate the company efficiently. The second point we have is they have shared inventory systems. So they can transfer the boats from one location to another to fulfill the customer order. And they have also launched a new app for customized ordering and payments. So now the main question is, why we should buy MarineMax? Our team has identified 4 crucial points that makes MarineMax an attractive buy. First is solid financial performance and acquisition to support growth. The second is market leader in a highly fragmented sector. Third is positive industry outlook. And fourth is attractive valuation and strong balance sheet. Now let's look at the acquisition history of MarineMax. So since inception, that was like 23 years ago, they have acquired 30 boat dealers, 4 brokerage accounts, and 2 yard repair operations. So that is a huge for a company. Their plan is to expand their operations through introduction of new product line, as well as acquiring new companies in different geographic locations. These are the recent acquisitions. The recent acquisitions is focused on 2 strategies. First, expand the higher margin business. To expand the higher margin business, they have acquired Skipper Birds and Niswa Marine, which will support them in marine and storage facilities. Their second strategy is to enter into manufacturing sector to diversify their portfolio. So for that strategy, they have acquired cruiser yachts and intrepid power boats, which will help them in diversification of their business. Now, Carlos will explain the solid financial performance and market share of the company.
Thank you, Natalie. Hello, everyone. So moving forward here, I would like to touch on the solid financial performance of MarineMax. When we're looking to invest in a company, we want to invest in a company with consistent history of earnings, with top line and bottom line growth, and MarineMax fits in this category. Even with Hurricane Irma, with all these natural events, they were still able to grow their revenues. And from 2016 to 2021, their revenues grew at a CAGR of 17%, and their diluted EPS over the same period grew at a CAGR of 49%. Now, aside from their spectacular performance, another interesting point here is the difference between the revenue growth and the EPS growth. MarineMax is a $1 billion company. They don't engage in aggressive share buybacks that could manipulate their EPS. So there's one explanation to why EPS is growing more than revenues. First, they're improving their operational efficiencies. Like Sam said, over the years, their revenue mix from their higher margin segments, the repair, brokerage sales, they also have partnerships with financing companies where they get a commission when the boat owner buys the boats from them. So all of those businesses are expanding, and they are also getting market share gains. Moving to the next point, they are the industry leader in the US boat dealership and repair. And the market share is also growing over the years. We found a comprehensive report from IBIS World, and since 2016 until 2021, their market share has grown from 4.9% to 7.6%. This is a highly fragmented industry. There's only one more boat dealer listed, and all the other companies are small players. So they have a big advantage of being that large size. They have good exclusive agreements with good suppliers, and they're able to get a better cost structure. And most of their growth has been through both organic and inorganic growth. Now, Hitali has mentioned that they have this solid history of acquisitions. And when investors think about companies that acquire a lot, a point of concern is that the growth is coming from the acquisitions and not from organic sales. And this is not the case for MarineMax. In the chart here in my left, I also have the same store sales growth from 2016 to 2021. And from all these periods, even despite the cyclicality of their business, they were able to register positive same-store sales. And aside from 2017 and 2019, the same-store sales growth was in the 2-digit range, even reaching 25% same-store sales growth in 2020. And another interesting fact, since 2015, their average stores revenue has grown at 89%. The next point I would like to touch on is the industry outlook. So over the past 5 years, the U.S. boat dealership and repair industry has grown substantially, and this trend is also likely to continue, although at a slower rate. From 2022 to 2026, the industry they operate is expected to grow at a CAGR of 2.3%, and thus this will help then with their expansion plans and improving top line and bottom line growth. Another relationship that we wanted to analyze was how MarineMax was growing in relationship to the industry revenue growth. And what we found out, since 2012 until 2021, they have grown at an average 3.27 times the industry growth. And given the cyclicality of their business, in order to incorporate any unexpected events that could happen in the next years, we decided to do our forecast with an average 2.28 times the industry growth, and we still arrived at an attractive valuation for MarineMax. The next point I would like to talk about is their strong real estate portfolio. Now, MarineMax, aside from doing all the acquisitions, they have been acquiring most of their retail locations, and we believe that this adds a lot of value to their shareholders. Since the company's inception, today in the US, they have 79 retail locations, and out of those 79 retail locations, 23 are owned by them. Although the majority of their locations are well localized at good places, and they also own 31 full-service operated marinas, including restaurants, storage, and service facilities. And given all these real estate acquisitions happening in a span of over 20 years, MarineMax believes that the fair value of their properties is considerably higher than the book value. And in fiscal 2021, they had property and equipment of $175 million, which represents a 72% growth since 2014. I will pass now to Tyler to continue with the rationale and evaluation. Thank you.
Thanks, Carlos. So first thing we're going to talk about is their strong balance sheet. So as you can see from the chart on the right, they've been sharply declining in their net debt to EBITDA ratio from 3.79 a couple years ago all the way down to negative 0.18 currently. Now, this shows that they have very, very strong capabilities to repay any debt and borrowings that they have. And this is due in large part to their $222 million worth of cash and equivalents, and because of their ability to use their $126 million credit facility with Wells Fargo as well as other banks, which assists them in their inventory purchases to reduce those costs. Another way to reiterate this point is by looking at the credit profile in terms of their current quick cash and interest coverage ratios. All of those reflect the same thing that this other chart shows, that they are very capable of repaying their debt. So next we're going to talk about their relative PE and their peer group. So we decided to analyze MarineMax in comparison to the S&P using a relative PE. Currently they're trading at 0.25, which is a third of the historical average since 2013, and it's half of this historical average since for the past 5 years. This indicates that MarineMax is severely undervalued in relation to the S&P 500. And not only is it undervalued in relation to the S&P 500, but also within their own peer group are they undervalued. As you can see, their EV revenue, EV EBITDA, PE, and PS ratios are also all well below their peer group averages, showing their low valuation. So some of the risks that we see MarineMax having to deal with are supply chain issues, interest rate problems, and economic problems. So for the supply chain issues, throughout the pandemic, we've seen many industries have to deal with supply chain issues, most notably the automotive industry with their semiconductor chip shortage. However, for the boating industry, this isn't as big of an issue because their supply chain or their supply issues come from a drastic increase in demand, not a problem with in terms of decreasing supply. So that is one way to mitigate that risk. Additionally, their interest rates. So interest rates are expected to increase in 2022, which means that people are less likely to buy luxury goods or high price goods like cars, boats, houses, those kinds of things. However, it's important to note that interest rates currently are near all-time lows, and it's likely that when they do increase in 2022, that increase will still leave interest rates below the historical average, meaning that people still have a higher propensity to consume higher luxury goods. Additionally, for the economy, the boating industry is a highly cyclical sector, and as my teammates mentioned before, MarineMax is shifting from that less cyclical, just new and used boat sales to their higher margin, less cyclical businesses, their parts, their repairs, their charter services, and their brokerage services as well. And so now we're going to get into the valuation. So we conducted a 3-part valuation using our DCF, our EV EBITDA, and our EV revenue multiples. For the DCF, we generated a price target of $83.30 using the parameters you see behind me. So we had a perpetual growth rate of 2%, a WACC of 13.9%, a 1.71 beta, and an 8.4% market premium. For the EV EBITDA, we arrived at a price of $81.46. We used a multiple of 6.75. We arrived at this number because we plan on foresee expansion based off their current multiple of 5.25. But we also wanted to leave it below our historic multiple of 8.83 and leave it below the peer multiple of 7.42, and we still arrived at a very high valuation. Additionally, for our EV revenue multiple, we arrived at 62.76 using a multiple of 0.57. We decided we wanted to keep that multiple stable with what their current multiple is sitting at because that multiple is sitting just below their historic 5-year multiple, and it's just over half of what their peer multiple is. So for our target price breakdown, we used 60% DCF, 20% each of the EV EBITDA and EV revenue multiple. And then for our price target, we arrived at 78.82 for 2 years. For the pessimistic case, we arrived at a price of 63.47. We calculated that by forecasting declining revenues as well as contracting multiples for the EV EBITDA and EV revenue multiples. And then for the optimistic case, we arrived at a 92.30. This is if the boating industry experiences faster expansion than what analysts are predicting, as well as increasing our multiples. So like I stated earlier, our forecast for our multiples is well below the historic 5-year for MarineMax and below its peer multiples. So if they did expand to those multiple levels, then that is the target price that they would hit. Thank you very much for your time, and now we'll go into the Q&A. We got Sam, unless you left it up from last time.
It's Ray.
So I can speak if you all are ready. It's fine. Can you hear me okay?
Yep. Yes.
Okay, terrific. And again, wonderful presentation. A lot of work went into it. Terrific job. Got 2 primary questions. First, the short interest here is pretty high. It's now in the double digits in terms of a percentage of total shares outstanding, and it's doubled over the past 6 months. So it seems like there is a bear case out there, and it seems to be gaining traction with institutional investors. What do you figure it is, particularly over the last 3 to 6 months?
So can you repeat the beginning of the question? It cut off a little bit.
Of course, short interest. So the amount of shares that are being short the stock right now is about what, 12-13% of the total shares outstanding. And obviously short interest represents a bearish bet against the stock. And that short interest has more than doubled, or essentially doubled, over the past 3 to 6 months. Okay. So that bear case is gaining traction. It's gaining steam, particularly of late. What do you figure that is, and why do you figure that you're not concerned about it, especially with your 40% upside here?
Yeah, so we noticed that the short interest has been increasing indeed, but even still, they're still trading at one of their lowest multiples compared to the 5-year EV over revenue, EV over EBITDA, and even their P ratio is trading at a lower multiple. They reported their fiscal 2021 full results, and the stock has gone up a little bit. So I would say it's probably that, but due to our research and our analysis, they are facing supply chain issues. I listened to the press release in the 4th quarter. He mentioned that the backlog is big, even though they don't mention that in the 10Q or in the 10K. But we're confident that even despite this 12% short interest, the company is still being traded at an attractive valuation.
Okay, and that leads me to my second question then. You mentioned that the MarineMax is trading at a discount to the peers, and I noticed it was trading at a really distinct discount to the manufacturers. Mm-hmm. And that's been the case for years, that the boat manufacturers tend to trade at a premium to the dealers or the retailers. Why do you think that is? What is it about the dealer business model that the market believes is riskier than the manufacturing base, and is that a concern to you?
You guys want to? I would say that they would see the dealer as a more risky because they have to obviously purchase their inventory from the manufacturers. One way that we see MarineMax alleviating this is that credit facility that I mentioned earlier. So through Wells Fargo and the other banks that they work with, they don't have to fully take on that whole cost initially. So they have a lot of room for purchasing inventory and then holding it. Obviously, they're not holding it now because of such a high demand. But in those in periods of low demand, then they have room to hold it and not have to deal with high amounts of debt.
Yes, and if I may add a couple points as well, I noticed Malibu Boats. There's a couple other manufacturers that they trade above. Obviously, they have their intellectual property, right? They have the intellectual property, so they sell their boats exclusively. But MarineMax, so 41% of the revenues in fiscal 2021 came from Brunswick and Azimuth boats. And like Hitali mentioned, they have these exclusive agreements. So 41% of the revenue, they have exclusive agreements with Brunswick and Azimuth that allow them to be the exclusive seller. But obviously, they're going to trade at a lower PE because they have this extra competition. But given how fragmented the industry is, there's a lot of small players and a few number of large players. We believe that MarineMax has an advantage to keep acquiring those more small players and gaining that advantage, that cost structure, their better cost structure, and the ability to expand even more.
Okay, thank you.
Perhaps building a little bit on what Sam brought up, there are a lot of red flags here, and so I want to congratulate you for using a WACC that you almost 14%. We almost never see one over 10% from students, so I think that's good. But even that might be too low given the uncertainty. And I didn't try to reverse engineer your PE ratio to other PE ratios, but certainly what you're bringing up is a red flag. But the other one, which I think is more significant given your analysis, is this is a company that for most of its years did not generate any free cash. And then all of a sudden they had a boom. They have 1 or 2 years now of free cash. And you show that free cash flow growing very, very quickly and very substantially. And so I just would ask you to help me understand why you feel confident that the free cash is going to grow so quickly.
Okay, so yes, the free cash flow has grown substantially now in the past 2 years, given the COVID trends and more people turning into boats. And in our forecast, we have forecasted a positive free cash flow for the next few years, but with a significant decrease, so we didn't keep the higher levels. That's where we accounted for the risk. We didn't account for any extra factors, but we believe that this trend of people turning into boats will be strong, and hence why they will generate free cash flow for the next couple of years, even though at a smaller rate than 2020 and 2021, because the industry is expected to grow at a smaller rate as well.
I'll just add one point that recently MarineMax made acquisitions of very big players like Skipper Boats and Fraser Yachts. And with these acquisitions, they have very successful operations. So with that, they will also have continuous free cash flow.
Okay, well, I hope you're right. I mean, it's a very big assumption against a lot of red flags, and notwithstanding the SNL routines about the guy who just bought a boat. But I hope you accounted for enough for the risk with the WACC. But good job.
Thank you.
Yeah, and mine was more of a, this is Mercedes Van working with Raymond James. Mine was kind of a follow-on to the last two questions regarding valuation and, and the short interest. I mean, if I look at the relative PE table too, basically it's telling me that the street doesn't believe the estimates out there. So, it may be worthwhile if, maybe the street isn't as aggressive as you guys. There's still a big spread there between, what the market's trading at versus what these guys are trading at or what the peers are trading at. So, maybe take a look at, maybe do some sensitivity analysis so that, you can see, where the stock would be if if they don't quite meet your numbers? Because in that relative PE table, what is your E? What E are you using? Are you using 2022 numbers, or what are you using as your E?
The relative PE, we did a historical, so from 2013 until 2021. And what we've noticed is that over the years, the relative PE MarineMax compared to the S&P has been decreasing significantly. Like you said, it may be that the street is not valuing the company enough, but in our thesis is that the results are improving. They're making their strategic of acquisition is improving. Same store sales, organic growth is also good. And we believe that this momentum of people shifting and becoming boating enthusiasts is going to keep growing. We did some sensitivity analysis in terms of the multiples, where we did multiple contractions in our worst case scenario. Even though they're trading at below their 5-year historical multiples, we did even extra multiple contractions in our pessimistic case. And for the DCF, we didn't do a complete sensitivity analysis. The only sensitivity analysis that we did was in the revenue breakdown, since most of it is related to revenue. So in our pessimistic scenario, we forecasted revenue declines for all the years, not significant, but around like 4 to 5% revenue declines until 2026. And that's why we got that price. But we should take a look more into Capex and all the other factors. We just didn't do a comprehensive sensitivity analysis for the DCF.
Great, thank you. Terrific job here.
So, ladies and gentlemen, very nicely done. This is Ray Ferrara. Full disclosure, I'm a boater, not of recent, but for a long, long time. So very familiar with the industry. A couple of different things I think you need to add into your thought process. First of all, comparing this stock to the S&P 500 and probably 450 other stocks in the S&P 500 against the S&P 500, given how cap weighted it is, doesn't really mean anything. Its growth rate hasn't been as great as the S&P 500. So consider that. Maybe if you compared it to the growth rate of the equal weight S&P 500, it might be more meaningful. The second thing I would say to look at is there will be, other than the minor recession that we had last spring or a year and a half ago. What happens in the next recession when all the people who bought these boats and financed the boats can no longer handle the boats and suddenly put them on the market? You are projecting out only 2 years, but if you had that recession, what would be the impact? Would MarineMax gain or lose as a result of that occurring? So just, you don't need to answer the question, just something for you to consider.
Okay, thank you. Any more questions? Thank you for your time. Thank you.
All right, that concludes our presentations for calendar year 2021. And I want to thank you again for joining us today. We expect to resume in person in spring 2022, and I sure hope to see you in Tampa and St. Petersburg next year. As a reminder, please don't forget to cast your ballot online, and I wish you a great Thanksgiving. Goodbye, everyone.